You've seen them, right? The bright, flashy ads interrupting your videos, plastered all over financial websites. Trade stocks for free, zero commissions. It sounds like a revolution. For decades, investing was expensive. You'd pay your broker a $5 or $10 fee just to buy a single share, a fee that would eat into your profits before you even had any. Then, a wave of fintech companies like Robinhood came along and promised a new world without commissions. The old guard, the big brokerage houses, had no choice but to follow. Today, commission free trading is the standard. But what if I told you that free is the most expensive word in finance? What if this whole revolution was built on a very, very profitable lie? The biggest lie in modern finance might just be the term commission free trading. And today, we're going to prove it. This isn't some conspiracy theory. We're taking a deep dive under the hood of your favorite trading app to uncover the hidden fees, the backroom deals, and the invisible taxes that brokers don't want you to know about. These are the tricks that can quietly drain your account, penny by penny, until thousands of your hard earned dollars have vanished. You think you're trading for free, but you're paying a price. You just don't see the transaction. We're going to expose how this system really works, who it benefits, and how much it's truly costing you. By the end of this, you will never look at a free trade the same way again. Before we tear down the machine, let's appreciate why it was built. The old system really was restrictive. If you only had a few $100s, paying a $10 commission to buy $100 of stock was a total non starter. You were down 10% from the jump. The move to zero commissions changed everything, opening the floodgates for a new generation of investors. Platforms like Robinhood didn't just offer free trades, they turned investing into a game, as easy as ordering food. And let's be clear, in many ways, this was a good thing. More people learning about investing and taking control of their financial future is a positive. But here's the catch: brokerages are not charities. They are for profit corporations with a duty to make money. So if they aren't charging you a commission, how are they making it? How did a company like Robinhood report a staggering $1.27 billion in revenue in just the third quarter of 2025, with analysts projecting their total revenue to approach $4.5 billion for the year? The answer isn't a single trick. It's a complex business model designed to extract value from you, the retail trader, in ways that are far less obvious than a simple fee. They've replaced a transparent cost with a system of hidden costs. You've been led to believe you're getting a free lunch, but in reality, you might be on the menu. The two most important ingredients are something called payment for order flow and the bid-ask spread. Understanding these is the key to unlocking the whole scam. This is the big one: payment for order flow, or PFOF. It's the main engine of the zero commission business model and the financial lifeblood of these free platforms. In simple terms, PFOF is a kickback. When you hit buy on your trading app, your broker doesn't usually send your order to a public exchange like the NYSE or NASD AQ. Instead, they bundle your order with thousands of others and sell that bundle, that order flow, to a giant third party trading firm known as a market maker. These are financial behemoths like Citadel Securities and Virtu Financial. For many zero commission brokers, the lion's share of their orders are routed to just a handful of these powerful firms. Why do these firms pay billions for your trades? Because retail orders are incredibly valuable to them. They're typically small and don't move the market, making them almost risk-free to execute the market maker's profit in the tiny space between the buying and selling price of a stock. And getting an exclusive first look at millions of retail orders allows them to capture that profit over and over again. To give you a sense of the scale, one report analyzing regulatory filings found that Citadel Securities paid a staggering 943 million US dollars for retail order flow in just 9 months during 2024. More recent data from Q3 2025 shows Robinhood alone received over $300 million for its options flow in a single quarter. This creates a massive conflict of interest. Your broker has a legal duty to get you the best execution, meaning the best possible price. But when a market maker is paying them for your orders, they face a choice: send your order to the place that gives you the best price, or send it to the market maker that pays them the biggest kickback. The incentive is clearly skewed. They are financially motivated to serve the wholesaler, not you. This practice has drawn intense fire from regulators. Former SEC Chair Gary Gensler has publicly questioned its fairness, and the agency has explored major changes. The core problem is the potential for retail investors to get a worse price, costing them billions collectively. The conflict is so obvious that PFOF is already banned in the United Kingdom and is being phased out across the entire European Union. Yet in the United States, it remains the bedrock of the free trading industry. Brokers will argue PFOF lets them offer free trades and that the price differences are tiny, but that misses the point. The system is built on a foundation where your broker is serving two masters, you and the company paying their bills. You don't see the fee, but you may get a slightly worse price, a few fractions of a cent per share. It seems like nothing, but as we're about to see, those fractions of a cent are just the start. If PFOF is the heart of the scam, the bid-ask spread is the knife. Every asset has two prices. The bid, the highest price a buyer will pay, and the ask, the lowest price a seller will accept. The difference is the bid-ask spread. Think of it like a currency exchange booth at the airport. They have a buy price and a sell price for euros, and they're never the same. If you buy euros and immediately sell them back, you'll lose money. That difference is the spread, and it's how they make a profit. Market makers do the same thing, just on a massive scale. Here's where it gets insidious. On a free platform using PFOF, you are often getting a wider spread. The market maker who bought your order has to make back the money they paid your broker, plus a profit. They do this by subtly giving you a slightly worse price. Let's make this real. Shares of XYZ are trading with a bid of $50 and an ask of $50.05. That's a 5-cent spread. On a premium platform focused on execution, your buy order might get filled at $50.02 a practice called price improvement. But on your free app, because your order was sold, you might get filled at $50.03 or $50.04. The wholesaler just captured that extra cent or two. Does a penny matter? Absolutely. Let's do the math. You buy 100 shares, that 1 cent difference costs you $1. Sell it later, maybe another $1. That's $2 on a round trip trade. Still sound small? What if you make 50 trades a month? That's $100 in hidden fees every month, or $1,200 a year drained from your account. For options traders, it's even worse. Spreads on options are wider, and research has consistently shown that retail investors tend to lose money trading them, partly because they're paying these hidden transaction costs and bidding up prices. This isn't just theory. One professor stumbled on this by placing identical trades at the same time in two different brokerage accounts. At the end of the day, one account was up $12 and the other was down $150. The only difference was the broker. You save a few dollars on a commission, but you could be paying far more through worse prices. I know this is a lot, but if you're finding this valuable and want to see through these market tricks, hit that subscribe button. My goal is to pull back the curtain on how finance really works, and your support makes that possible. Now let's get back to the other ways your broker is making money off of you. PFOF and wider spreads are the main pillars, but the business model of a free broker is like death by 1,000 cuts. First, there's the upsell for data and tools. On professional platforms, real-time market data is standard. On many free platforms, it's a premium feature. Want to see prices now, not 15 minutes ago? That'll be a monthly fee. Want to see level 2 quotes showing the depth of bids and asks? That's another fee. Suddenly, your free platform is a subscription service just to get the basic information you need. Next up, margin interest. This is money you borrow from your broker to trade. While this is a standard profit center for all brokers, the marketing can be tricky. In the past, free apps often charged much higher interest rates. Today, the market is more competitive, and some fintech brokers like Robinhood actually offer some of the lowest rates available, often beating traditional brokers who might charge 11% or more for smaller balances. This is an area where the free model has actually forced some positive change, but it's still a huge moneymaker you need to watch. But the cuts don't stop there. Want to move your account to a different broker? Many platforms charge an account transfer fee, often $75 or more, creating a penalty for leaving. And we have to talk about cryptocurrency. Many free stock apps now offer commission-free crypto trading, but this is where some of the most outrageous hidden fees lie. An app might advertise zero commissions, but then charge a built-in spread that can be as high as 1% or 1.5%. That's not a real market spread, it's just a massive commission called by a different name. On a $10,000 Bitcoin trade, a 1.5% fee would cost you $150 right off the top. It's a pattern. The headline feature is free, but everywhere you turn, there's a hand in your pocket. This isn't just about a few clever companies. It's about a market structure that regulators are struggling to fix. In the US, the SEC has rules like Rule 606, which requires brokers to publish reports on their order routing practices. In theory, this gives you transparency, but these disclosures are often so complex and buried in fine print that they are almost useless to the average person. It's transparency in name only. As one researcher put it, I can't think of any other consumer finance product where costs are different and it's not disclosed. The global regulatory landscape tells the story. As we mentioned, PFOF is already banned in the UK and on its way out in the EU because regulators there decided the conflict of interest was just too great. In the US, it remains legal despite repeated calls for reform. A recent push by the SEC to force retail orders into more competitive auctions was eventually scrapped after intense industry lobbying, a major win for the wholesalers and zero commission brokers. This leaves the average investor stuck in a system tilted against them, a system where free is a marketing term, not a reality, and where the deck is stacked to ensure the house, the brokers, and the wholesalers always gets its cut. You've seen how hidden costs add up for one trader, but to understand the true scale, we need to zoom out. A groundbreaking academic study did just that. Researchers analyzed millions of trades to quantify the total cost of these execution differences. The number they came up with is hard to wrap your head around. They estimated that due to these practices, retail investors are collectively losing approximately $34 billion a year. Let me say that again, $34 billion. It's a massive systemic transfer of wealth from Main Street to Wall Street, siphoned from the accounts of millions of ordinary people. The study suggested that simply improving trading costs by a tiny fraction, just 0.1%, could save investors $20 billion of that. This should be presented as one study's estimate, but it highlights the true cost of free. It's not the dollar you lose on one trade, it's the tens of billions that may be vanishing from the system every year. The zero commission model didn't eliminate costs, it just atomized them into invisible pieces, spread across billions of transactions. It is, as some would argue, a multi-billion-dollar heist happening in plain sight. So, what's the takeaway? Should you stop trading? Absolutely not. The point of this is not to scare you out of the market, it's to arm you with knowledge. The best antidote to a scam is understanding how it works. You now know free isn't free. You pay through payment for order flow, which creates a conflict of interest. You pay through wider bid-ask spreads and invisible tax on every trade. And you pay through a dozen other hidden fees and upsells. Now you can see them. So what can you do? Investigate your broker. Don't just take their marketing at face value. Dig into their SEC Rule 606 report. See who they route orders to. Sometimes paying a small, clear commission is far cheaper than the hidden costs of a free platform. Use limit orders. Stop using market orders. A market order says, fill me at any price, leaving you vulnerable. A limit order lets you set the exact price you're willing to pay or accept. This gives you control and protects you from bad fills. Consider your trading style. If you are a long-term investor making a few trades a year, these hidden costs will have a minimal impact. But if you are an active trader, these costs can be the difference between profit and loss. For active traders, finding a broker known for excellent execution is critical, even if it means paying a commission. The era of free trading isn't going away, but you no longer have to be a victim of its hidden costs. You can make informed choices, you can trade smarter. The lie only has power over those who don't know the truth, and now you do. I want to know what you think. Has this changed your view of your trading app? Let's talk about it in the comments. Sharing our knowledge is how we as a community can fight back against these systems. And if you want to take the next step, be sure to watch my next video, How to Choose the Right Broker in 2025, where we'll do a side-by-side comparison of the top platforms, looking at their true costs. Thank you for watching. Now go be a smarter investor.